Hello, I'm Valentin Khokhlov, CFA, and that's the second stream of my new project, the Investment Club, where we are speaking of portfolio management, risk management, and investments in general. Excuse me for small delay with beginning of this stream because I've just finished my stream in Russian, so I decided to make two versions, both English and Russian version, because some of my friends are English speaking and they asked me to show them something in English. So this stream is dedicated to returns, calculations, tips, issues with financial data, and investment performance evaluation, at least with some aspects, because it's a large topic. We only touch some of the aspects. So let's start. So return is the most basic category in investments, and probably each investor is interested in return because it says how much profit he or she got relative to the initial money invested. And the total return for period T is the length of the period, is calculated with this simple formula. So you get the final price at moment T, the initial price at moment 0, and the current income for the period, for example dividends or interest or whatever you get from the investment during the period, and you subtract the initial price from the final price, so you get the profit, and you add the current income and you divide it by the initial price. Or you can regroup those components into basically two components. To capital gain, which is what you get in price of the asset, and the dividend yield, what you get in current income relative to the initial price. You also need to know that the total return, as per the formula above, it's a gross return. If you're interested in net return, you need to subtract brokerage and management fees, for example broker commission or fee, exchange fee, custodian fee, etc., which is only a part of transaction costs. And the other part is investment management fees, which you pay to your investment manager, or if you are an investment manager, the money you get for providing services to clients. And the clients will be interested, of course, in what they get after those transaction costs. So it's a net return, but the net return before taxation, because there's also after-tax return. They get to their pockets after taxes have been paid, and they need to know, and they probably do know, the difference between realized and unrealized gain. Realized gain occur after the securities have been sold, and unrealized if you had bought them but haven't sold them, so you got some securities in your portfolio and you get some profit, some gain, but before you sell the investments the gain is unrealized and you don't pay taxes, but some time in future you will need to pay them, so you need to account for those future tax obligations as well. And you also need to account for different tax regimes for dividends, interest and capital gains. In many countries capital gains are taxed higher than dividends, and some bonds have like tax-free interest. For example, in the US, many municipal bonds in some European countries, government bonds are exempt from taxation. So basically, for retail investors, for individuals, it is important to account for those differences. For many institutional investors, it's not important because investment funds, they are not taxed at fund level. Only those participants of the fund are taxed when they get the distribution from the fund. So basically, most of the investment managers don't bother to calculate after-tax returns. It's unique for every and each investor. So basically, it's what investors should do, and the investment managers, they don't typically calculate after-tax returns. So what you should get from them is the total return gross of fees and total return net of fees. That's basically it. And you also need to distinguish between actual return, you calculate using the transaction prices, the model return, or sometimes it's called paper portfolio, that is calculated using the close prices of the previous trade day. And it is important because in many instances you don't have transactions for every security in your portfolio, but you need to value your portfolio at many dates, and you have to use some price which would be the close price of the previous trading day, and you inevitably have to get part of model return for your portfolio. And I would say that most of the returns you calculate will be model returns, and actual returns only in some trivial cases. When you buy security, you sell the same security, and only in that instance you will have the actual return. But when you have model and actual return, you have some difference, which is called implementation shortfall. It's literally the difference between the model and the actual return, and it consists of the transaction cost, because the actual return is net of transaction costs, and model return is typically gross of transaction costs. So it's the first component of the difference. Second component is the difference between the transaction price and the close price of the previous trading day, because let's say the decision has been made on December 31st to buy a stock, and the close price was 100, and on the first trade day of January you are buying that stock. You are not buying it at close price, of course. There's a bid-ask spread, and somewhere in between you buy that stock. Let's say you buy for 100.50 cents. It means that 0.5% of the return is gone because of the higher actual price compared to the close price. It's the difference between the transaction price and the close price. It's the second component. Moreover, you may not buy the stock on the first trading day, you may buy it on the third trading day. For some reasons you forgot, you were sick, or there were no offers at your limit order. It went unfilled. So you postpone the transaction, and each day you postpone is the delay. The delay cost is the third component, the difference between the close prices of the decision day and the day before the transaction day. So if you postpone it by 3 days, you basically have the first trading day, the second trading day, and the close price of the second trading day, and the decision day, which is December 31st, will be this third component. And finally, some transaction may never be implemented at all, so basically don't buy the stock which you were supposed to buy, and the profits lost from that unimplemented trade is the fourth component of the implementation shortfall. And all components besides the transaction cost, they may be positive or negative, of course. Because if you haven't bought a stock which declined in price, you'll have a positive shortfall, because the stock would have been a loss for you and you didn't buy it, so you would generate profit from not doing that transaction. And that's basically can go for second and third component as well, because the price may go down, and the difference is basically your gain to the shortfall, not your loss from the shortfall. And as an investor, you may be interested in the mean or average return. For example, you made a 210% return over 7 years, so your investment of $100,000 increased to $310,000. What's your mean annual return? How much you made each year on average? The naive approach to use arithmetic mean, divide by 7, got 30%. Is it true? Let's see. 100 grew to 130, then to 169, and so on to 627, which is way too high. Something does not work here with the arithmetic mean. The correct one is the geometric mean, it appears. So you need to take the square, not the square, the root of power t from 1 plus return. So the 1 plus return is 3.1, and you get the root of 7th power. It's roughly 17.54% per year. Let's check. Does it work? 100 to 117.54 to 138.16, and so on to 310. Yeah, that one is correct. So you need to use geometric mean if you would like to find some average return over a long period. It's also called compounding or geometric linking, and the concept of compounded annual growth rate is basically the same. So you get the return for year 1 at 1, multiply by 1 plus return year 2, multiply by, and so on, multiply by 1 plus return in year t, which should be the same as your total return plus 1, or 1 plus average this geometric mean return in power t. And basically, if you see this formula, you now realize I made a small mistake here. I forgot to subtract 1 from this expression, and from this expression, and from this expression, because if you take this root, you will get not 17.54%, but 117.54%. So you need to subtract 1 from here, here, because you see it here. Yeah, you get this root of power t, and you get not the average return, but 1 plus average return. So don't forget to subtract 1 when you get this root. And there's another opportunity which many practitioners use, called logarithmic return. So it's logarithmic return is a natural logarithm of 1 plus normal return. And if you remember the rule of logarithm, the logarithm of the product is the sum of the logarithms. So basically get the logarithm from all those parts, and you get here the sum of logarithms. You get here t multiplied by logarithm of 1 plus r average, or it's the same as logarithm of the 1 plus total return over 7 years. And then you replace the logarithmic return and you see it's just the sum of logarithmic returns, and the average here is the arithmetic average of those returns. So basically when you shift to the logarithmic returns, you just use arithmetic mean, which is convenient basically. But you need to remember to get back from this logarithmic space to normal returns by taking exponent of this RC. So taking exponent and subtracting 1. So which issues we have with price data when we calculating those returns? We need to get some stock prices, right? The first issue is delisting. No data for trading days when the stock is delisted. For example, some stock was delisted in year 2011 or 2013. Now it's 2021. It's long gone from all databases. So you need to get some legacy databases, which is not often available. Or you need to save all your updated databases when you making a decision regarding a particular stock, which I do at the moment because I faced this issue in 2016 first, that delisted stocks are not available anymore. So I started to save updates at the time the decision was made. Second issue is dividends. Basically, when you get dividends, you need to add them to your pricing data. It's not a problem if you add them, it's not difficult, but you need to keep track. And many financial data providers say adjust prices for dividends. So basically, when you get a dividend for a stock, they retrospectively, so looking backward in time, they decrease the previous prices, close prices, in such a manner, and if you use only those adjusted prices, you will get the same returns as if you used the dividends with raw prices. So basically adjusted prices are convenient. You don't need to bother with adding explicitly those dividends. But there are two issues. First, when you get your transactions recorded, you have raw prices there. You don't have any adjustments. If you combine your raw prices in your transaction log and adjusted prices from the database, you have discrepancy between those prices. It does not work. Just you cannot compare prices for the same stock the same day. You have two different prices. One price is raw price for which the transaction was made, and another price is adjusted price you got from the database. Is the first issue. The second issue is the date of the adjustment. When you get the dividend, you know when it comes to your brokerage account. So basically your broker, your custodian takes care of that, and the financial data provider does not know what the exact date. So there may be a discrepancy about 1 month between the date prices have been adjusted in the financial database and the actual date when you go to dividends. It's a minor issue, of course, but still you need to be aware of that. Much larger issue are stock splits. For example, when I tried to create the first stream to prepare data for them, I found that my portfolio data, when I tried to calculate to value portfolio at each trade day, they looked strange. At the end of each month, the data were adequate, but then the portfolio went down, 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 then up again at the end of month, then down, 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 and went up. What was the reason? And I found that was due to Apple stock split, two stock splits actually. one was 7-1. So in 2014, for each stock of Apple before June 9th, you got 7 new stock, and another split last year 2020 on August 31, 4-1 split. For each one stock you got before, you got 4 new stocks. So in total, if you were keeping one stock from 2010, Apple stock, now you would have 28 stocks of current Apple stocks. The same problem with Nike, actually. The smaller coefficients 2-1 and 2-1 in 2012, 2015. So basically how I changed that. The problem was that when I started like my portfolio management, like model portfolios, Yahoo Finance, which I use for financial data, they provided raw prices, adjusted for dividends and raw at all, not adjusted for stock splits. And I used those prices. But from 2017, I think, from August probably, they changed the financial database and they started to provide data adjusted for stock splits, including retrospective adjustment. So all the prior financial data were changed, and that caused the discrepancy between my data and the new data from Yahoo Finance. So I had to unadjust those prices by multiplying them for Apple by 28 or by 4, and for Nike by 4 and then by 2, to get raw prices as they were at the time of the transaction. And then the discrepancy disappeared. So everything goes fine, but it's a lot of manual work for like tracking those stuff. And there was another split, very strange looking. Why it's 2,202 shares to 1,000. What is that? Actually, it was not a stock split, it was a spin-off which Hewlett-Packard made in October 2015. It became effective in stock data on New York Stock Exchange on November 2. So one old stock of HP Incorporated called HPQ, the ticker HPQ, it became, after what was the spin-off? HP Incorporated divided into 2 corporations. The new HP Incorporated had roughly half of the old business, and another half went to Hewlett-Packard Enterprises. And Hewlett-Packard Enterprises were listed under HPE ticker. And the prices were different. Similar but a bit different. And in order to keep consistency from old HPQ to new HPQ in their financial database, apparently Yahoo Finance made that artificial split, which was roughly equivalent at that particular date to this split. So the holders of HPQ stock, according to Yahoo Finance financial database, would experience no drop or no gap in their returns on this date if they use this split ratio. Basically, it's a good solution for that particular date, but after that, those stocks they're separate securities and they have different price dynamics. Obviously, this ratio will not work after this date. A new ratio is needed, and the correct solution would be to manually enter for each one HPQ stock before this November 2015 to enter into portfolio one HPE stock, because it was like the spin-off rule, and then account those two stocks separately, and if you don't need HPE stock, just sell it after some time and buy new HPQ stocks. That would be the correct way. And basically, if you had an actual brokerage account, you would have just that. You would find a new HPE stock in your portfolio. But if you use financial database, you will have some strange splits like that, which is not very obvious how to deal with. But well, that's the life. I found no ideal data providers. Well, maybe some commercial data would have no such issues, but I'm not sure of that. Okay, so the methodology, how to calculate return in real life. So basically you need to value the portfolio at the dates of all external cash flows, which is mandatory. You must do it. External cash flow is a cash flow from your investor to the portfolio, like to invest or to divest some money. The dividends, they are not external cash flow. Stock split, not external cash flow. Only when investors puts money or withdraws money, it's external one. Desirably, you need to value the portfolio periodically. At the each rebalancing day, you need to value it, and well, desirably each month, at the end of each month. Then you, for every sub period between the valuation dates, you calculate the return as per slide 2, the formula, where the P0, it's not the investment, but the value of the portfolio at the beginning of a sub period, because the investment might change in value. It's not the amount of money that had been put initially. It may go up or go down, so you need to use a new base. And transaction costs, if you need to account them, you need to account them in each sub period separately, otherwise it would not work. And you need, after that, you need to link sub period returns geometrically as per slide 4 here. And if the period is longer than 1 year, you need to annualize, to convert to annual returns. An example. Suppose that on January 1st the investor invested 100,000, let's say US dollars, let's say 100, just omit thousands, added 50 on February 15th, and on March 3rd the portfolio got dividends of 2,000, and on December 31 the portfolio was valued at 157. You need to know what was the value of the portfolio as of February 14th, and good to know the value at the end of each quarter if we assume quarterly rebalancing. If we assume monthly rebalancing at the end of each month, but let's suppose quarterly rebalancing. And those values on February 14th 103, on March 31 153, on June 30 147, on September 30 151, and on December 31 157, as we mentioned before. So the returns calculation is pretty much straightforward. To February 14 the portfolio earned 300, which corresponds to 3% return for the period. And then the investor put 50, and you accounted 50, added them to 103. So the new base is 153. You get no capital gain, but you got dividends, so it's a return. Here please note the mistake here, because the base would be not 153, because the 153 was the price, and don't forget the dividend. Actually, the mistake here is only in the PowerPoint, but in calculations there's no mistake. The base was actually 155, and here you see 155. The portfolio dropped by 5%, more than 5%. And next quarter, some gain using the base 147, which was the value from the past quarter. And the fourth quarter, I put no dividends here. It's not hard to put dividends. The formula would be the same like this one, but it's technical, just not to bother you with too much details. So you get 5 sub-periods. You link them geometrically, 1 plus return multiplied by 1 plus return, and so on, and from the product you subtract 1 and you get 5.7%, and it's annual because the period was 1 year. We don't need additionally to annualize it. Let's suppose there was a brokerage fee $600 and management fee $1,400 for the full year. If you decide to add that transaction cost, to deduct the transaction cost at the end of this year, you would screw the calculation basically, because you cannot use any single base to calculate those costs, to calculate the corresponding deduction in the returns, because you have different bases for each of 5 sub-periods, and you cannot divide 2000 by initial 1000 or 1050. It would not work, because of the wrong base you'll get the wrong result. The correct way, the only correct way, you need to know what was the brokerage fee during the first sub-period and investment management fee in the first sub-period, and deduct from this return. Then this second period, what was the brokerage fee, what was the investment management fee for this period, for third period, for fourth period, for fifth period, for all of them separately, and then recalculate using net returns net of the transaction costs, and then you get net returns for the year. There's no shortcut here, unfortunately. You need to process each sub-period separately. Some words about risk measures. So basically, the total risk measures the volatility of returns, both downside and upside volatility, and the measure is the standard deviation, and the efficiency measure is the Sharpe ratio, which is your return for the portfolio less the risk-free return divided by the standard deviation. It's how effectively you get the return above the risk-free rate per the unit of risk, per one standard deviation of the returns. Another concept, systematic risk. We'll talk about all those concepts in a separate stream dedicated to risk. It's just a very brief overview at this time. So systematic risk measures the sensitivity of the portfolio or asset returns to the changes in the market or index returns. So the sensitivity to of particular asset to the market, and the coefficient called beta or beta. I don't know, in Greek it's called beta. So we have efficiency measure called Traynor ratio, which is the return of the portfolio less the risk-free return divided by the beta, so by the unit of systematic risk. The downside risk, it's what many investors are interested, only the downside. They are afraid of the downside, of losses, not of the upside. So they care about volatility of those returns that are below than a specific threshold. For example, 0. So all returns less than 0 basically losses, what are the volatility, or the returns lower than the risk-free rate. And the corresponding risk measure, efficiency measure would be 13 ratio, which is risk of return of the portfolio less the threshold divided by semi-standard deviation, which is calculated only for downside returns. And finally, tracking error, which is useful for tracking portfolios when you need to assess portfolio management relative to some benchmark. So basically assess the volatility of the difference in returns between the portfolio and the benchmark. And the risk measure is called tracking error volatility, which is basically the standard deviation of that difference in returns. And the corresponding efficiency measure called information ratio. And the information ratio is the return of the portfolio less the return of the benchmark divided by the tracking error volatility. So that's it, a very brief overview. And here is a sample analysis for 5 portfolios. And here is the first column is the benchmark called SPY. SPY is the ETF tracking the Standard & Poor 500 index, which is proxy to US stock market, at least large cap market. So I use it as benchmark and 5 portfolios here. Portfolios that were described in our first stream. So you see here the geometric mean return, daily mean return, arithmetic daily mean return, standard deviation of daily returns, and then the green background is the annualized return, and then annualized standard deviation, then beta coefficient, Sharpe ratio, trainer ratio, tracking error volatility. Why it's 0? Because it's a benchmark, and here you have volatility comparing to this benchmark, and the information ratio, and below is the correlation matrix, and how all of those is calculated. Let me open the file with the calculations so you can see all the formulas here. So it's in the Google Sheet, so you see on your screen both those numbers and the formulas in the formula bar. So the first is the count, the number of samples of the observations in the sample. And then for the geometric mean, you see this array formula, which I used based on the logarithmic returns. So I use this the array of row returns, normal returns. I add 1 and take the natural logarithm to convert that array into the array of logarithmic return. And if you remember, I now can use just normal arithmetic mean. So I use average for this array, but I need to convert back to the returns. So I took the exponent and subtracted 1. So it's the formula. Here you see 2 functions which are specific to Google Sheets to tell Google Sheets that the formula is the array formula. In Microsoft Excel it's simpler. You just start with the exponent, you put everything here, you up to this bracket, and when entering this formula, you instead of pressing enter, you press Ctrl, Shift and enter to tell the Excel that you need to enter it as an array formula, and the result would be exactly as this result in Google Sheets as an array formula, and you get this geometric mean. Arithmetic mean is just average. Standard deviation function stdev. How to annualize. Here in this particular formula bar I put 251 trading day. Actually there are 252 trading days, So I corrected that. So here you see 14%, actually it's, in the presentation is slightly more because I corrected it. But the logic is the same. You use the geometric mean return plus 1 and you raise it into the power corresponding to the amount of trading days in a year, or trading periods if it were monthly mean return. You would put power of 12 because there are 12 months in a year. So you just annualize like that. To annualize the standard deviation, you need to multiply by the square root of the number of trading periods. So here you see square root of 252, which is the correct, basically, number of trading days on average in a year. To calculate beta, you need to use function called slope. The slope corresponds to the coefficient in a linear regression, which actually is beta. Then the Sharpe ratio, you see the return less 3.2%, which is risk-free rate I took from the average yield on US Treasury bonds for the period, and divide by standard deviation, which is the Sharpe ratio. For the Trainer ratio, the same return less the same risk-free rate, but divide by beta. The tracking error volatility, by definition, is the standard deviation of the difference between the portfolio and the benchmark returns, and you see it's exactly that. We have here the difference between two arrays. So one observation less one observation, and you then convert it to array formula to calculate standard deviation for this array of differences. And you get the standard deviation for daily differences. To annualize, you multiply by the square root of 252 of the number of trading days. So that's how you calculate the tracking error volatility. And then you calculate the information ratio as the return of the portfolio less the return of the benchmark and divide by tracking error volatility. And to calculate the correlations, you use correl functions with two arrays. Calculation is pretty much straightforward. So all those key financial metrics are calculated here, but the question is, you got those for one particular case. We assume that you invested on the 1st of March of 2010 and held the portfolio up to December 31 of 2020. What if you invested your money on a different date, on 2nd of March or 7th of September of 2011 or so on? Or what if the horizon was not 10 years but 3 years or 7.5 years or whatever? You need to calculate everything for that new period, which basically you cannot do for each particular investor. Every time a calculation for each possible starting date and investment horizon. So we can use rolling returns. The rolling return is a return we calculate for a specific horizon, for 1 year, let's say. The horizon may be different, but let's say 1 year. So we start on 1st of March of 2011 and calculate return for 1 year before it. 1st of March 2010 to 1st of March 2011. Then we shift our window by 1 day to March 2nd and calculate 1 year return before. Then March 3rd, 1 year before, and so on. So we shift our window, which is always the same 1 year window, by 1 day, and we get different returns for 1 year holding period. And we see the sample of all possible 1 year returns that any investor could obtain during the period, the entire period. And those represent all possible cases inside that period, all possible cases of 1 year investment. And then we use that sample to assess the investment performance. Let me show you how it works. There's alternative way, more complicated, which is a Monte Carlo simulation, where you randomly select the starting date and the length of the holding period, and you calculate one observation, second, third, and so on, and you calculate many random observations of starting date and holding periods, and you calculate returns for all those different holding periods, which is more time consuming, not very difficult actually, it's doable. I will show how to do it, but rolling returns are simpler to use. Let me show you how it works again on our data file. So basically it's here, and if you see, I need to scroll down because I cannot calculate rolling returns before I get 1 full year. So here you see 1st of March 2011, and we have return for 1 year. 2nd of March, 1 year before, 3rd of March, 4th of March, and so on. So we get different returns over the period of 1 year, exactly 1 year. And then we use this sample of 1 year returns. Because it's all of those are 1 year returns, you don't need to use geometric mean. You use only arithmetic mean because you don't link those returns. Those are different cases. So you use arithmetic average and standard deviation as well. You use just standard deviation. Don't need to do anything with those. And you see the data are different. The results are different comparing to raw returns. You cannot calculate beta here. You need to, I just put beta from copied from the raw returns. You can calculate Sharpe ratio and Treynor ratio using rolling returns. You cannot calculate tracking error and information ratio. It does not make sense. So if we get back to my presentation, you see I removed those because no sense. And you see figures are slightly different. We'll see in more details what are those differences for, but basically all the remaining metrics you see for rolling returns as well. And also you see this second row, I put the number of observations where for one particular year you obtain a return higher than the benchmark, than the SPY ETF. So for aggressive portfolio, about 2/3 of observations were higher. For tracking portfolios, actually less than half observations. For balanced portfolio, for brick portfolio, pretty few of observations provided returns higher than SPY, than Standard and Poor's 500 index. So basically there's some charts. You see we can make some conclusions. We see initial period for most of 1 year time windows, we get returns higher than S&P. Red dots aggressive portfolio and solid black line S&P 500. We got returns mostly higher. Blue line is a balanced portfolio. It was supposed to be lower because it's balanced. It has bonds, it has precious metals, so it's not as profitable as stocks. But here you see second period, about the same range of aggressive portfolio and S&P 500. And the third period, you see, for some years, 1 year horizons, the returns of the aggressive portfolio were in a negative zone, whereas the benchmark, the index, was in a positive zone, which basically means this portfolio behaved quite poorly during this time. And here below you see dynamics, the rolling returns for the tracking portfolios, which initially tracked the S&P index quite close. And here we see the deviation only during this time. Here we see again the tracks quite closely. And here again we see they fail to track. Well, it's hard to track 500 stock portfolio with only 5 stocks or 15 stocks. So it was just like an attempt to see how it behaves. So it's the last slide, but we can switch to data file. Let me show you sub-period data. So basically I divided into 3 sub-periods from 2010 to 2013, and here you see raw returns 2 times higher for aggressive portfolios than for the index, and slightly less for tracking portfolios than for the index. In rolling returns you see about the same picture in terms of returns, but not so in terms of standard deviation. For standard deviation you see here is about 16%, 23%, 18%, 16% standard deviation. But for rolling returns you see much lower volatility. What does it mean? Here we take daily returns and we annualize, and daily returns are much more noisy, much more volatile. Here we get standard deviation from different 1 year holding periods, and 1 year holding period you see the daily volatility smoothed out on this time horizon. That's why this risk when we measure it by rolling returns is lower. Anyway, when we measure risk by monthly returns, it would be lower than when we measure it by daily returns. It's quite expected. And here we see the only time period where brick portfolio delivered quite interesting returns. It was the initial period when I created the brick portfolio. When we use the second time period from 2014 to 2017, you see aggressive portfolio, it's quite good one. It's above roughly 1.5 times higher return than the index, and the rolling returns as well. There's some discrepancy between the tracking portfolios, especially when we use rolling returns. They are slightly lower than benchmark. Balanced portfolio is about 2 times lower, especially if we use rolling returns. And brick portfolio, know that it was a poor one during this period. and the volatility was high, but the return was very low. So it was a bad choice, definitely. And we see a tracking error here for 15 stocks, less than 5% per year. Not bad. Well, it's good if it's below 4%. 5% is not very good, but we can live with it. 7% tracking error for 5 stocks, it's high, actually. And then last period from 2018 to 2020. What you see here, you see that the aggressive portfolio was 2 times worse in returns, in terms of return, than Standard and Poor, and the risk was quite high. If we use the rolling return, you see the tremendous difference. The return was quite low, less than 2%, and if you remember the chart, let me show you, probably on this Google Sheets as well. It's below. Here you see this purple one is aggressive portfolio. You see it was in a negative zone pretty much of this period, and the index was in a positive zone. That's why we have such a low rolling return, and in my opinion it's more adequate than to measure by this normal return, because it's for the entire period, and here we average all 1 year sub periods, and you see the difference is quite significant. Also, you can note the balanced portfolio as well, not very good one. BRIC portfolio was in a negative zone, so Brazil, Russia, India, China, probably some of the countries delivered very bad investment performance. So that's it. So different periods had different dynamics, and if we look only here at the top of the screen where I put only the summary for the entire period, you would miss some inter-period differences which were quite significant. So, and actually you can see those differences, you can note them if you look at the rolling returns. You see here you expect that aggressive portfolio would have very good performance because it's in a very high level, it has very high level of returns. Here it's better than index, but not very much better, and here it's in a red zone, it's in a negative zone. So you can note those differences between sub-periods here in this particular chart. If you look at the overall returns chart, which is here, you see the accumulated capital gains. They were quite high for this aggressive portfolio, and it dropped. Here you can really see it dropped, but you probably it's hard to notice that here it's actually it was a very bad investment. It recovered by the end of this period, so the overall result was good, but here in this sub period it was quite bad. And some analysis, example of analysis I performed for one of my colleagues who is a fund manager, and I was invited as independent person, so I didn't manage those funds, so I was able to assess their performance as an independent person. Here I would like to show you two different items. First, downside semi-variance or semi-standard deviation, how to calculate it for Sortino ratio. So what you need to get? You need to get only those samples that are below some threshold. This threshold here, it was monthly returns and the monthly risk-free rate. And you please note this formula. So it's if the return is below the risk-free monthly rate, I use this return, the difference with the risk-free monthly rate. I use the square because I need to calculate the variance, which is square difference. And in the opposite case, I put empty cell. I ignore it. I consider only non-empty cells here. So in all non-empty cells, I will have a squared difference for the months where the return was lower than the risk-free rate. And then I sum those, I average those, I took square root, and that would be the semi-standard deviation, which is used for Sortino ratio calculation. Unfortunately, you cannot use a simple formula. Here you need to use separate table like this one. And finally, speaking of Monte Carlo simulation, how to do it? It's not that complicated. You need two columns with random number generator. So you randomly generate the length of the holding period inside your overall period. So you see here rand function. I use some tricky calculation just to ensure I don't go out of the entire holding period. So I use some sub period of that holding period. So I use this rand to generate randomly the lengths, and you see the lengths of holding periods are quite different here. And then I also use random number generator to generate the starting date. Again, some calculations to ensure the starting date and the ending date are within the entire holding period. And the ending date is simple. I use the start date plus the length of the holding period. And then I calculate the return over this holding period, which is quite trivial because I look for the ending portfolio value, I look for the starting portfolio value, and I use the prices adjusted for dividends and so on. So I just use price returns and annualize it considering the number of days in the holding period. I use calendar days here because I cannot just use trading days in this particular instance. So that's how I use the Monte Carlo simulation to simulate different, I think I used 10,000 different tries to simulate like 10,000 different potential investors with random holding periods and random starting date. So that's basically how to use Monte Carlo simulation. That's all I wanted to tell in this stream, and next time probably we'll talk about risks or some other topics which are relevant to investment management, portfolio management, and investments in general. So if you are interested, stay tuned, subscribe to my channel and subscribe to updates, set reminder for the investment club